All right. Hello, everyone. Welcome to RMDs in 2021, our latest presentation on that annual phenomenon, taking your required minimum distribution. So, we're going to go through today the basics of what an RMD is, how to take it, if you, at least if you work with us, or the process is pretty similar, no matter who you work with, and when, why, how often to take it. All that stuff we're going to get to, as well as maybe a couple advanced strategies that you can think about what to do with the money once it does come out. But let's do some defining. So, you spent decades saving for your retirement in a pre tax account, either through a work account or an IRA. I'll have a list of all the ones that are subject to this in just a second. But you worked hard, you sacrificed, and now you're retired and doing well enough that you don't have to take the money from your retirement savings. Some of you may be in that camp where you're saying, I don't actually need this RMD. Maybe that's why you're here. You're saying, Anthony, what do I do with this? Well, I've got some ideas. But first, let's talk about what the actual nuances around RMDs are. Then we can talk about what to do with them. So the rules can be a little confusing and the penalties, by the way, for not taking your RMD can be kind of severe. So those are things we definitely want to avoid. And fortunately, we're good at avoiding them. We're good at helping you avoid them. But we need to talk about what it is. So RMD stands for required minimum distribution. You take them when you're retired. Required minimum amounts that retirement account owners must withdraw the year they turn 72. Now you're thinking, I heard about age 70. Isn't it age 70? It used to be. Actually, at the end of 2019, early 2020, and this all got kind of lost because of the pandemic, they changed the age from 70 and a half, which was just confusing in general, to 72. So the year you turn 72, and by the way, if you were taking RMDs, you don't now get to skip age 71. If you were in 2020 supposed to take an RMD, or in 2019, if you already were at that age, you still have to keep taking them. So that there was a brief overlap where some people were confused. Now we're kind of far enough away from it where everybody knows. But if you are younger than 72, once you hit 72, that's the magic year. So, required minimum amounts that retirement account owners must withdraw the year they turn 72. RMDs are taken from traditional IRAs, SEP IRAs, 401ks, 457s, and more. 403bs, for example, would also be included there. Basically, think about plans that you put money into pre-tax, where you have not yet paid tax. That's the idea. So if you have not paid tax yet, the reason you are required to do this distribution is because the IRS wants you to pay taxes on portions of that money over time. If you put in, your 20 bucks a check when you first signed up for your work retirement plan, that money still has not been taxed all the way back from when you earned it. Well, eventually the IRS is going to get their money. So that's kind of the purpose behind it. But on the flip side, a Roth IRA, which is an IRA where the money has been taxed before it goes in, that is not subject to RMDs because, as you would imagine, the money has already been taxed. So they don't need to have you take money out. So that's one of the things that makes Roth powerful. By the way, a little nuance here. A Roth 401k or a Roth 457, even though those are accounts that the money has already been taxed before the money went in, those are subject to RMDs. So, one way to think about getting around that is if you roll the money from a Roth 401k or a Roth 457 or a Roth 403b or what have you, a work account that's a Roth, into a Roth IRA. That avoids that rule and doesn't incur any taxes. So, that's one thought right off the top. Um, a couple 2020 changes, as well as, we're looking at maybe what's going to change in 2021 as well. First off, the Secure Act. Now, that was the one that changed the RMD age from 70 to 72. That was the biggest change that affected most people. Now, don't forget also the CARES Act, which was the first stimulus package passed back in 2020 in the spring. That actually waived RMDs for 2020. So you were not, even if you were the right age, you were not required to take your RMD in 2020. RMDs have been reinstated for 2021. Obviously a law could pass and things could change, but as it stands right now, RMDs are back on for 2021. And that is the big piece of info. We got a 1-year moratorium. Everything is back to normal this year as far as RMDs go. So a lot of people ask, well, I thought I heard RMD is a percentage, but how do they do a percentage? My account balance changes every day, maybe. Well, your minimum distribution is actually calculated on the end of year balance. That's December 31st. So they're picking that point in time, December 31st of the year prior. Important to know. So if you turn, let's say you turn 72 in January, they will use the December 31st balance when you're still 71 of the year before you turn 72. So just keep that in mind, and we can help you calculate all that. It's not too difficult a thing. So your minimum distribution is calculated based on the end of year balance of your retirement account and a life expectancy factor published by the IRS. You can look this up in a couple slides. We actually have a nice graph that'll show kind of how this looks. But basically, the percentage that you take out increases as you age. They're making you take a bigger chunk of the pie as you get older. So that's one way to look at it. You can always take out more than your RMD. Important. You're not limited. You just have to take out that amount. But if you take out more than your RMD 1 year, it doesn't roll over and credit to the next year. So you don't get credit for having taken out more. So you could take out as much of your IRA as you want, or your qualified account, assuming you're retired and the nuances there are satisfied. But it's not going to count toward future years required distribution. Just keep that in mind. And I have to say it because it's a big thing. We don't ever want to run into this, and we'll make sure we don't. But the penalty for failing to take out enough to satisfy your RMD by the deadline, which I'll get to in just a second, is a 50% tax on the undistributed portion. So if your RMD is 10 grand, you're going to pay a 5 grand penalty in addition to the taxes on that 10 grand. That's a big penalty. We definitely want to avoid that. So I promised you the table here. Now, if you zoom in or if you pause the video, please look to see what applies to you. And by the way, this table is still reflecting people age 70, even though the age is turned to 72. So just look at the line that says 72. It'll be easier. But when you turn 72, you are required to take out 3.67% of your account balance. That's how the math works here. By the way, if you're looking at what is uniform table RMD factor, take your balance on December 31st and divide it by that number. That's how the IRS is doing it. We just did the math for you and got that percentage out because it's a little bit easier to visualize that way. But notice it goes up every year, and it starts out fairly small, by the way. I think a lot of people are under the impression that, okay, they're going to make me take out half my account every year until it's all the way gone. Well, two things. First off, no, not nearly that much, at least at the start. And two, if you take out only a percentage of your account every year, it will never actually go to zero if that's all you're taking out, because a percentage is always based on what's left. So yes, the number will decrease and decrease and decrease and decrease. But if you're only taking out a percentage all the way up to, and I would love to meet you if you're somebody who falls into the last row there, the 120 plus age. But if you make it that far, yeah, they make you take out half your account every year. But even if you still have $100 in your account, there's still going to be 50 left after that. So just a thought experiment. But this is a very handy table. Please pause. Please, take a screenshot, whatever you need to do. That's a very helpful way to kind of visualize how this is going to go on. So one of the things that is on the table are maybe some changes happening here. So, and why would that happen? Well, life expectancy over the last 20 years has increased by more than 2%, which, 2% doesn't sound like a lot, but when you're talking about years of a life, that makes a big deal. Not just for people, but for the economics we're talking about here. So it's actually increased by more than 8% for Americans who have already made it to 65. So if you're already 65, your life expectancy is 8% longer than it was 20 years ago. So despite this fact, the RMD tables rarely get updated. And in an exciting, and you can agree or disagree whether it's exciting or not, exciting for me, an exciting turn of events, the IRS released its much anticipated proposed changes to the table, which are estimated to be put into effect in January of 2021. Now, as of today, these changes have not been put into place, as I understand it. So it's something we're watching. It's something they may consider. But if I flip back and forth here, If you look at the current, which is this slide, versus the proposed, yes, the percentages are a little bit bigger, but it's not an astronomical change. So it's just going to change a little bit at the margins. It's one of those adjustments that they make as, life expectancy goes up. We need to continue to adjust our expectations based on that. So, how will your RMD affect your tax situation? Great question. RMDs are treated as ordinary income, which means you will be able, just like on any IRA distribution, you will be able to withhold tax potentially to pay up front rather than having to cut a check to the IRS at the end of the year when you're filing taxes. But it is going to be income. So it's going to add on to, potentially your pension or even maybe your work income if you're still working at RMD age. But since they will resume this year, make sure you take that into account as far as your tax plan. Now, here we're to one of the big questions. A lot of people ask, is there any way for me to get out of this IRA? I don't want the money. I don't want to take it out. What can I get out of it? You can't get out of it, but there is one way you can avoid the taxes on it. And that would be something called a qualified charitable distribution. It's what this green box is referring to, the second one down. And it's a non-taxable distribution of your RMD to a qualified charity or charities. I'll say you can do it to multiple. So how does that work? Well, it has to be a direct transfer. It's not like you're going to take the money into your bank account and then write a check. No, we're sending the money directly to this charity or nonprofit. By the way, who qualifies? As long as you're a 501c3, you qualify for this, which is the IRS tax code for nonprofits. So look up, if you're interested in this, look up where you want the money to go and see if they can accept it. A lot of places do. We've been able to do this with a lot of success in the past. But how it works is you get a statement that then says, yes, your RMD was satisfied, the money came out, but since that money was directly transferred, it does not become a part of your income when you do your taxes. It does not. So it's a great way. And what I usually recommend is if you are, and here's one other slippery rule, this qualifies back to the old RMD age. So even if you're only 70 this year or 70 and a half, because that was the old age, you can do this even before you have to take out your RMD, because those numbers used to be pegged together and then the RMD age moved, but the qualified charitable distribution age did not move. Maybe it will in the future, but at least as of right now, it has not. What that means is if you are 70 and a half or older and you are giving to charity already, and that's just part of what you do, it is probably, or I should say possibly, because it always depends on your situation, going to be the most tax efficient for you to give that money directly out of your IRA or work account, or actually, I should clarify that in a second too, out of your IRA. Now, I said IRA and then I stumbled over the work accounts, right? Because this is only possible with the rules that are in place right now. This is only possible from an IRA. So if you have a 457 or a 401k and you'd like to take advantage of this, you have to move the money into an IRA first before you can do that. That's a pretty simple transaction. It's called a rollover. We can help with that, but that is what you've got to do before you can do a qualified charitable distribution, because it has to be an IRA, at least with the way the law is right now. So talk to us, obviously, please, about tax efficient strategies for how to deal with your RMD. And also, let's talk to your tax specialist too, because they deal with this every day, just like we do. And it's important to kind of have a full picture in mind. So after you've paid taxes, you can use the funds however you like. This is the classic question: what can you do with your RMD? Anthony, what should I do with my RMD? Well, first off, it depends on what your lifestyle is, right? I always say if you need the money, that's what you do with it. If the money is going to help you live in retirement, that's number one, the first thing we do here. But there are some people in a situation where they're saying, actually, I don't need this money. What can I do? So after you paid the taxes, and we talked about the charitable distribution, so that's one thing. But after you paid the taxes, let's say you take the normal distribution, you're paying taxes like everybody else, you can use that money however you like. You can actually put it in your savings account. You could reinvest it potentially into a taxable investment account. So a lot of people say, well, the big thing that bums me out is I have to take this money out and then it's no longer invested. Well, we can reinvest it. It'll be in a taxable account, which is a little bit different than, your work account or IRA were, but it's still an investment. And we can talk about what makes the most sense there. But that's definitely a popular strategy. You can contribute to a college savings account for a child or grandchild. That would be a great way to maybe pass that money on to the next generation. You could just straight up gift it to someone. You could send it to a charity and get the tax benefit. Basically, there's a lot of different options, and we want to talk to you about what makes the most sense. That's kind of our opinion on this. Is your situation is often going to dictate what the best move for you is going to be. So I promised to talk about deadlines. Here they are. Dates to receive your RMD and successive RMDs. So there's a little bit of a trick here. I almost wish that they would just make it one date. But if this is your first year, if you have turned 72 this year, you need to take your RMD out by April 1st of 2022. So they give you a 3-month grace period after the end of the year on your very first year. That is a one-time gift. After that, once you're in your second or third year, and by the way, for people who were still subject to the old 70.5 rules, this is also passed you by now. So you're on your second or third year. Basically, if it's not your first year of having to take an RMD, you need to have that money out by December 31st. And you might be saying, well, is there an advantage to waiting until April 1st? And the answer is, I guess there could be. But know that if you do wait till April 1st on your first year, you then have to take your second RMD out also before the end of that same year. So let me make the example. If you are 72 this year, and this is your first year doing RMDs, let's say you wait until March 31st, 2022. You're going all the way up to the deadline. You then take your RMD out for 2021, but it's calendar year 2022. All right. Before the end of 2022, you then have to take out your second RMD to satisfy for 2022 by the end of that year. Now, think about that for a second. When you do your taxes, you're going to have not one, but 2 RMDs on those taxes because they were both taken out in the same calendar year, even though one of them satisfied the year prior. So just keep that in mind. And again, that's something we can talk about, whether that makes any sense or not for you. It's a case-by-case thing. We talked about the penalties. Again, it's something we very, very much want to avoid. We're very good at it in our office of making sure that this is happening right when it needs to be. But it never hurts to make a plan. It never hurts to call us and say, hey, you can call us and say, hey, I want to avoid that 50% tax. But most of the time it's going to be more like, hey, I want the money then or now or over a period of time. And that actually speaks to something I'll interject here just for a second. You have the option, depending on what account you have, but in general, you're going to have the option of when to take out your RMD. I get that question a lot. When should I do it? You could take it on January 1st. You could just get it over with. You could take it on December 31st. Just forget about the April 1st for now. I'll just say let's just say it's your second year or later. You could also take it out in 12 equal slices over the course of the year. And the one that's right for you depends, again, on your situation. But just know that you very likely, depending on how your account is set up, that's one caveat, will have the option to do that. So again, that's something to talk with us about. All right, charitable donations. So a lot of questions about this lately because of the way the tax rules have changed with itemization. So first off, ineligible to do this qualified charitable distribution, which I talked about earlier, to a donor advised fund. If you don't know what a donor advised fund is, it's a fund that you can set up that you can contribute money into and then regularly dole it out to charities. But while it's sitting in the account, it's still invested, so it can actually grow. So a qualified charitable distribution does not count if you're directly funding a donor advised fund. That's all I'm going to go into it right here. If you want to hear more about the specifics of how those two things work or don't work together, call me and we can kind of talk about it. But in general, just know that. you cannot also send it to an organization that donates on your behalf. That's basically what a donor advised fund is. But there are also organizations that donate on your behalf. No, this has got to go directly to a charity, and you're not ever going to see the money. It's not going into your checkbook and then you're writing a check. It's going directly to the charity. That's the only way the IRS is satisfied to say, okay, you get that off your taxes. And by the way, it's not an itemization. It's not a line item that you write in. It just comes off the top of your income. So that's one of the powerful things about it. Reported how you would a normal RMD. And we got a lot of questions about this because it's been a more popular thing over the past couple of years. So you're going to get your statement that says you took out this amount of money. It's probably, and again, your mileage may vary depending on what kind of account it is. It's probably not going to say with a special stamp right here, hey, this was a qualified charitable distribution sent to the Red Cross or wherever, and hey, you're good to go. It's just going to notify you that the money was taken out of the account. We know, and we have the proof that it was sent to the charity. So don't worry if you just get a statement saying, okay, do they know that the money went to the charity? Yes, we've got all that covered. We know where the money went. It's just a reporting thing. So that is a very quick and brief, but I hope powerful look into how to deal with your RMD, who is required, who's not required, maybe some ideas for how to get the most out of it for you. But I hope you've picked up on the idea that underpinning all of this is the idea that what's going to work best for you is what's going to work best for you. I'm not going to be able to give you a one size fits all answer here. So I appreciate you guys watching. I would love to hear questions. Please leave a comment below. Check out some of the other videos on our channel, or check out our website. Here's some quick disclosures. You can pause the screen and read these if you'd like. But please contact us if you've got questions about this. That can be done through leaving a comment. That can be done through our website, or call us or send us an email. We would love to talk with you about your specific situation. And with that, thanks for watching.